We've now gone through the 3 production pages that the program has. There might be some other enterprises that you would be involved with, such as a broiler enterprise or maybe a honey enterprise, that don't exactly fit into the format for those pages. But they can be customized to a certain extent, and some pages can be added if you feel you have the skills to do that. We're now going to look at the summary pages in this section, the income expense summary page and the debt servicing summary page. The first of the 2 summary pages in this section is the historic livestock, cropping, and dairy enterprise analysis page. You'll see that information comes to this page from the previous pages. This page is divided up into the 3 production areas, the livestock, the crops, and at the bottom, the dairy. In addition to the first column, where the information comes in from the previous pages, you'll see we have 5 historic columns to the right where you can add information from historic information. And this would normally come from tax returns or financial statements. Between the projected column and the historic columns is an average column. And the average is calculated from the 5 years or the 5 columns of historic information. The income numbers come in as a lump. The expense numbers come individually as you've provided information and broken down the expenses on the previous pages. Something to mention about the average function is that what the program does is it looks to historic years for information until there's a cell where there's no number. So just looking at the straw shredding expense item, you'll see that we have a number for the first historic year and the second historic year and the third historic year. But in the 4th historic year, which is December 31st, 2011, there is no amount. So instead of just leaving that cell blank, we've put in 0.1. So when the average function is working, the program is able to go through the full 5 years to calculate the average over 5 years. If, however, you wanted the average just to be calculated on the basis of the first 3 years, then of course that 4th year would be left as a blank. One of the real values of this page is that it allows for comparison of past to projected. And in using this page, you should always do that. So we have the historic information for the 5 years, and then the average and the projections. If the amounts that are projected don't relate to what is shown in the past, you may want to go back and question whether or not your projections for income and expense are correct. For example, for veterinary expenses, we've projected them to be $1,435 in the upcoming year. And historically, the amount of the expense ranges anywhere from $822 to $2,380, and the average is $1,458, which is very close to what we've projected, so we could probably assume that that would be a reasonable projection. In the livestock area, when we look at machinery repairs, you'll see we've projected $5,000, and in the past we haven't had anything. The same for building repairs. However, as in most farm operations, those expenses come in under crops. So you'll see for machinery repairs, if you look down into the crop section, you'll see that we've projected $28,000 for machinery repairs, and the past average is $32,846. So if we add the projected $5,000 for machinery repairs for livestock to the $28,000 in projected machinery repairs for crops, we have $32,000, which compares very well to the average of $32,846. The last page in this section, and the second summary page, is the income expense and debt servicing summary page. All the past and projected income, expense, and debt service information comes forward to this page. It calculates and displays information for the past periods and the projected period. And accrual adjustments to past income and expenses can be chosen, or the information can just be left as cash. So as we move down, you'll see there's cash and accrued income, cash and accrued expense, cash and accrued net farm income, non-farm contributions, which is wages, interest income, and other contributions, non-farm withdrawals, living costs, income taxes, and other withdrawals. Then debt service capacity is calculated. And payments are also shown. And that is as the payments were defined on the liabilities pages. From all that information, budget surplus is calculated. And that is the difference between debt service capacity and the payments. As well, at the bottom of this page, to the left of the projection numbers, there's a little area that's headed year 2. The reason that is in is because in the year after the projection year, the payments might be slightly different depending on how the liabilities are set up. If, for example, a loan is going to be taken out in the projection year that doesn't have payments until the following year, the payments will be a little different in the long term compared to what we've projected in the projection year. And an example of that is that new loan that we were going to have taken out for the haybine and the baler. So it had one payment in the projection year, but the full semi-annual payments are going to happen in the year following. Because we've defined the liabilities as we have on the liability statement, the program is able to calculate what the payments would be in the next year. So if you feel that the year 2 numbers are more representative of the situation on this farm, you would want to have the program use the year 2 numbers to calculate debt service capacity and budget surplus rather than the projection year. You'll see at the very bottom there's a cell that is described as send the smaller DS requirement to the risk ratios page. The way the program is set up, the higher payments of either the projection year or the year 2 are used to calculate budget surplus and debt service capacity in our summary statements. So if you want the program to use the lower payment amount to calculate that information, you would put a Y in that cell. If you put your cursor on that cell, you'll see the comment box that says if you want the smaller debt service requirements to transfer to the risk ratios page, put a Y in this cell. If you want to see how that works, look at the risk ratios page. Click on the risk ratios tab at the bottom of this page. Look at the results. Then go back to this page and put a Y in this cell and see how the numbers change on the risk ratios page. I've put together a little illustration to show how this works. So in this example, we have a new loan coming in the projected year of $200,000, semi-annual payments. It's going to be advanced in January of 2015. 20-year repayment period, semi-annual payments of $15,000, first payment due July 1st of 2015, and then the second would be in the next year, January 1st of 2016. In this situation, the annual debt service capacity for the farm is $35,000. So you can see in year number 1, 2015, the payments are $15,000, and that's that first payment due July 1st. In the second year, however, 2016, both payments are going to come due. So the payment requirement will be $30,000. That's the payment January 1st and then the payment July 1st. So you'll see in 2015, with payments of just $15,000, the debt service ratio is 2.33. That's the debt service capacity, which is $35,000 divided by the payments. But in year number 2, when the full payments of $30,000 come in, the debt service ratio drops to 1.17, which again is the debt service capacity of $35,000 divided by the payments of $30,000. So in this situation, you would want to show the numbers for year 2 because they are most representative of what the situation actually is. The projected revenue and expenses will always be calculated on an accrual basis because the program has the information to do the accrual adjustments. For the past, you can choose to have the income calculated as accrual or just be left as cash. The information that you'll be entering in the past columns will most likely be cash information. If you want the program to do the accrual adjustments to convert that into accrued revenue and expense and net income, you will enter Y's in row 2. And you'll see we've done that in this example. And that's in the row that says, do you want to do accrual adjustments? You then need to have the information in the program to do the accrual adjustments. So if you've entered all of the information in the historic or for the historic year ends on the net worth summary page, the program will have the information it needs to do the accrual adjustments. If you haven't entered that information, you can enter information in the accrual adjustment section at the bottom of this page. And I'll just scroll down and show what that is. And that's in the area at the bottom where it says accrual adjustment amounts. You'll see that because we've entered historic year-end information on the net worth page and also the net worth summary page that we'll be coming to later, the program has the information to do the accrual adjustments. You'll see for the market livestock, for example, we've got the totals in the blue cells. So with that, the program is able to make accrual adjustments to the livestock income. If you haven't provided that historic year-end information on the net worth pages, you can add it in this section, the accrual adjustment amount section at the bottom of this page. And you'll need to provide information then on inventories, supplies, payables, receivables, and accrued interest. If you provide that information then and have the Y's entered in row 2 at the top of this page, the program will do the accrual adjustments and generate accrued income statements for the historic periods. For those who might have some questions about how that works, I put together a few slides and a couple illustrations to show how cash income numbers are converted to accrued. First of all, a little bit of information on accrual adjustments. So accrual adjustments convert cash income and expense to accrued income and expense. Cash income and expense are the cash that flow in and out, and you saw that in the crops page and the livestock page where we showed the sales of livestock and crops, and that would be cash, and we showed the projected cash expenses. Accrued income represents the value of the production, and the accrued expense represents the cost to produce it. And when we're just dealing with cash, revenue, and expenses, we don't always capture the full value of production and the full cost to produce it. But the accrual adjustments help us to do that. So to convert cash income to accrued income, we take the cash income and we add or subtract changes to production, inventory, crops, livestock, etc., and accounts receivable. To convert cash expense to accrued expense, we take the cash expense and then we plus or minus changes to supplies such as fertilizer, fuel, etc., accounts payable, and accrued interest. Now a couple examples. First of all, I'll show one that occurs on the income side. So we're going to look at a projected year, which is 2015 in this case. And the year runs from January 1st to December 31st. So in this example, we're starting the year with 100 cows and they have a market value of $200,000. For production, there are going to be 100 calves, but none are going to be sold. So we'll end the year with 100 cows worth $200,000 and 100 calves worth $100,000 for a total of $300,000. So you'll see that the cash income is actually zero because no animals are sold. But the accrued income, which is the value of the production, is the $100,000. So the accrued income is calculated by taking the cash income and adding the $100,000 of change of inventory to give $100,000. So in this example, even though the cash income is $0, the accrued income, which represents the value of production, is $100,000. The second illustration shows accrual adjustments on the expense side. So we'll look at the same year, 2015, running from January 1st to December 31st. We're going to start the year with $20,000 worth of fertilizer on hand. And during the year, all that fertilizer is going to be used. So we'll end the year with no fertilizer on hand, $0. So the cash expense for fertilizer is $0, but the accrued expense for fertilizer is actually $20,000 because $20,000 worth of fertilizer was used. So we do that accrual adjustment again from cash to accrued by adjusting the cash expense by the change in fertilizer on hand for the year. This illustration shows how that would be done.